Now, of course, last year, the housing market, well, it set records, seeing growth of more than 22%. That's the largest annual rise since 1989. So, with the new year underway, to discuss what the market looks like this year, Anthony Landahl from Equilibria Finance joining us now. Anthony, a very good new year to you. Thanks for joining us again. So, yeah, pretty hard to follow from last year's quite amazing growth that we saw across the board there. Is this year all about those rate hikes that we know are coming? I guess it depends on who you're hearing from at the moment. We just heard from Westpac saying they're now expecting the first local rate hike to be in August. So is that a potential cloud over the property market?
Yeah, g'day Andrew, and great to be here, mate. And that's probably been one of the most common questions I've been asked around the barbecue over the last month is can the market be sustained? And look, I think what we need to look at is what fueled the market, and is that fuel still on the fire to look towards 2022? So essentially there were four major factors that really fueled last year. We had low interest rates, we had high household savings, and COVID sort of COVID actually helped that with a lot of people saving a lot of money. We had government stimulus packages and we had low listings. So that confluence of factors led to that 22% increase as you discussed. And some interesting data is that the value of Australian houses grew $2 trillion in that 12-month period to be over $9 trillion. So what will 2022 bring is a very common question, and generally speaking, the forecasters, the banks, we're still looking at above average growth of maybe 5 to 7%. But what we're seeing is those factors that fueled the market last year are slowing down a little bit or have in fact been impacted. We're now seeing affordability constraints because of the rate of growth. We're seeing additional listings come in as people look to capture that growth in the market. We've seen an increase in rates. And we're also seeing some tighter credit policies with APRA stepping in. So that confluence of factors last year have already started to be impacted. And the forecast is that growth will slow to still above average, but maybe around 5 to 7% nationally.
So are you expecting perhaps increased supply to take further heat out of the market then?
Yeah, we've already seen increased supply. Spring tends to see that, and we saw that at the back end of last year with supply up 15 to 20%, and we're continuing to see increased supply in the market. But it's a confluence of factors, Andrew. We have got genuine affordability constraints for owner-occupiers, and the APRA buffer rate increase has also impacted borrowing capacity by maybe 5% or so. So the factors that drove the market last year, some of the steam's coming out of that, and a bit of a wild card in all of this is actually the economy. And as you hinted, Westpac's already looking at whether a rate rise will come in earlier. And if we see strong growth in the economy, if we see inflation, if we see wage growth starting to increase, that might impact the RBA's decision making around when we actually see an increase in rates. And that's a bit of a wild card at the moment, how strong the economy will grow and how that will flow through to inflation and wages growth and ultimately the interest rates.
Anthony, last year the market was very much driven by owner-occupiers, particularly first-home buyers getting into the market. But of course, as you now mentioned, some of those prices now to the point where it's locking a lot of people out of the market. Therefore, is it going to be all about investors this year, do you think?
Yeah, that's an interesting, investor psychology is always an interesting thing to try and look at. But the short answer is investors are coming back into the market. And while I think we're going to have some volatility over the next couple of years in terms of the rate of growth and how the economy plays out, if investors are taking a long-term view, they're seeing some value in the market, as distinct from, say, cash or bonds. They're really starting to see property as a potential opportunity. The reason for that is we're still looking at a growth of rate of 5 to 7%. We're seeing some good rental returns of between 2 and 4% real returns. Last year we had housing rents grow 14% and units was about 9%. And we're also still seeing cheap money, relatively speaking, for an investor of below 4%. So there's a lot of things that stack up for investors at the moment around the market's growing from a capital perspective, yields are growing, and money's still relatively cheap for an investor. So there's value there for investors, and they are streaming back into the market.
So, Anthony, where are you seeing the growth this year? Be it houses, units, city, regional? What are your thoughts?
Yeah, a lot of the growth last year was around Sydney, Melbourne, and a lot of the regions. A couple of sleepers last year were Brisbane and Adelaide, and they're seeing a little bit of a surge in growth. We're also seeing units coming back into the market. Units were really badly impacted with the COVID lockdowns, with movements and stuff like that. But we are starting to see the units become more attractive for investors. I think a big thing for investors, Andrew, won't be so much the regions or the cities. It's where they're finding the value. And that value is partly due to the owner-occupiers having affordability constraints. And we're also seeing a shifting in preferences of tenants. And we are seeing a bit of a shift from investors from for properties that might have a home office, or for more lifestyle sort of properties where people want to live, they're working from home. So it's a bit of a shift in the type of property, but we also are seeing a little bit of a surge at the moment in areas like Adelaide and Brisbane that maybe didn't pick up such the big rate of growth last year.